we see extreme volatility in stock markets as geopolitics and rate concerns create panic, leaving traders looking to tech earnings and FOMC to provide some support. Tight commodity markets outperform, with gold and crude oil looking bulletproof. All this and more in this week's Macro Insight. Okay, so welcome back to Macro Insight, everyone. Today is the 25th of Jan, and let's take a look at these markets. So what's been going on? Pretty crazy times. It was a mixed bag for markets last week, which was obviously clearly a risk-off episode for equities, and particularly for tech stocks. But if you look across the board, there are a few other things happening, right? So, we've obviously had more and more rhetoric that the Fed is behind the curve, and might even raise rates 50 bips in March. That's what people are starting to get quite spooked about. Personally, I don't see it happening, but you never know. Can't rule it out. But just, a lot of macro guys have been saying that they're just so behind the curve. They have to do something. They're still buying bonds, for crying out loud, in the face of these inflation numbers, and Biden's going on at them to get this under control. So they kind of need to get some credibility back. And that's what the market's kind of realizing, and realizing to get that credibility back means they're going to have to be a bit more aggressive. Okay. And kind of care less about what equity markets do in the short term. That's the idea. So obviously we had US stocks and crypto, the worst hit. And, they were hitting sort of 2 to 3 sigma moves. Chart that Macro Hive put out every week kind of breaks all the weekly moves down into sigma, into volatility adjusted moves, right? So you had 2 to 3 standard deviation moves down in a lot of these US names and indices, broad indices. But then you had European markets holding up relatively better, given that they've got more of a value tilt, right? So you saw, the likes of the DAX and Eurostox and FTSE, more like 1 sigma type down moves. Okay. Commodities, on the other hand, held up, pretty well, with precious metals, gold obviously up, silver, nearly 2 standard deviations up. No doubt the benefit of some crypto weakness there. As I've talked about, that negative correlation between precious metals and crypto, I think they're definitely benefiting from that. But even some of the other commodities, the likes of oil, copper, hanging in there with a positive week last week. Yeah. Now, on the week, rates were relatively stable. So obviously interest rates have been the reason for a lot of this sort of turbulence in markets and volatility in markets, the repricing of interest rates. But if you actually look, whilst we had about 4.25 hikes priced in at one point, given the risk-off tone that took hold and the negative sentiment and the kind of risk asset liquidation that happens, we saw that come back out again to be slightly lower than 4 hikes priced for this year. And we saw similar price action in bond markets rallying back a bit. So now, the Fed's due obviously to speak on Wednesday. All eyes are going to be on that and how hawkish they actually come out to be, and whether they try to calm markets down and just be like, yes, we know we've got to get inflation under control, but that if they're too hawkish, the equity market falls out of bed, and then that's kind of not really what they want, right, over the longer term. So, they're kind of walking on a bit of a tightrope. Also adding volatility to markets was OPEX on Friday, providing its kind of monthly dose of volatility and bearishness, as we've been seeing quite evident in markets recently. And that kind of gave the perfect recipe for that Friday puke into the close. Obviously, markets are pretty short gamma, as these Spotgamma charts kind of show us, and we'll be talking about, particularly in the NASDAQ, but also on the S&P. The street has been short and therefore chasing its tail, whichever way the market goes, really struggling to get any equilibrium, any stability, basically. And then the overhang that often comes after a big expiry, you have some more positioning that needs to be flushed out. You often get that on the Monday, maybe even the Tuesday, before markets can then start to stage some sort of bounce. And that's the pattern we've been seeing over many expiries over the last year or so. Now, we saw that, right? Yesterday, we saw the overhang persist. We saw markets down best part of 4 or 5%. And then they turned aggressively and ended up green on the day, which is probably a bit more than you would have anticipated. But, you know, it was some crazy price action there. And it was cold. It was kind of exacerbated by that short gamma that still clearly is there in the street. The geopolitics out of Russia and Ukraine, the fear of invasion and what kind of sanctions are going to get slapped on Russia and things like that, and how this conflict's going to escalate, also added to the risk off tone. And that didn't help, but I don't think that's ultimately the driver of where markets are going to go and where they're going to end up over the next sort of few weeks. Yeah. So we talked about the short gamma nightmare for dealers. Staying on that topic, if we kind of look at what's been going on and what the VIX has been up to. So obviously the chart on the left shows you kind of the drawdown across all the main US indices. So we've got Russell, Dow Jones, S&P, NASDAQ, you know, all of them pretty much. Well, Russell went through 20%, which is like the technical bear market barometer that people use. Yeah. NASDAQ down 17 at the lows there. And the S&P and the Dow were down about 10% apiece from their local highs. If we look at what the VIX did, term structure inverted as you would expect. And that inversion was pretty dramatic, right? So I think what we're looking at here is the difference between spot and futures. That inverted dramatically, got to around 7.5 vol points. Highest levels we kind of seen since the COVID crash. Okay. So that's, you could argue that is a sign of pretty much extreme negative bearish sentiment, right? And then you've got the VIX curve, obviously the term structure flipping, inverting. That front end got as high as around 33, I think, in terms of the front month contract. That snapshot there doesn't kind of show that intraday high, but yeah, curve inverting. So a lot of the things we were talking about with Spotgamma last week on the YouTube live that we did, and he was saying, you know, why is the VIX not really spiking on the way down? I was like saying, because we haven't reached any new territory in spot. Once we accelerate through those lower levels, expect to see a spike. And that's exactly what we saw, because, you know, breaking those supports is where the market goes into unknown territory, doesn't know where it's going to end, and then gets forced to capitulate and buy a load of protection. And that's kind of what we've seen now. Okay. Fundamentals are clearly deteriorating. There's some signs of that. You know, as to why are we all of a sudden getting so bearish, or why is the market getting so bearish? I wouldn't say we're necessarily getting that bearish. So you had, you know, things like Empire Manufacturing rolling over pretty dramatically, tends to be a bit of a leading indicator on stocks. And you know, a chart that I found interesting, and this is from the Bank of America strategy guys, basically is that, you know, does the Fed actually need and want to engineer a sell-off in stocks to almost force people back to work? And the reason why I'm saying that is because if you look at what happened with the Kospi, and as the Kospi has been coming down, and it's been coming down since, you know, last summer, you've had this pickup in the participation rate. So more people coming back to work, i.e. cost of labor goes down, inflation comes down a bit, right? So is that what they're trying to engineer? And you know, this is why people are saying the Fed put is at lower levels, because they don't mind a sell-off in stocks. You know, we've been so used to thinking they can't handle a 10% drop in stocks, but maybe now they can handle a 30% drop in stocks, right? We don't know, but clearly, you know, we'll see what message Powell comes out with this week. I personally don't think it's going to be particularly reassuring for the market and particularly calming, because I think he doesn't mind seeing stocks a bit lower. And because, you know, Biden's not the same as Trump, right? Trump was all about make sure the stock market keeps going up. I'm not sure Biden's as sort of fussed about that right now. He needs to take care of inflation, and that is the top priority. So I think, you know, that's what the market is obviously starting to discount already. But any optimism that we get in stocks into FOMC, personally, I think is probably a fade, right? Would I own a few call spreads, call options, call ratio type structures for March on the S&P? Sure. But am I going to go long a load of delta into the FOMC? Probably not. And then, you know, what else we're seeing in terms of the tech stuff, you know, echoes of the dot-com bubble bursting, right? So these charts, again, Bank of America flagged this one where you're comparing Berkshire Hathaway to Invesco back in the day, where we had the tech bubble in the 99-2000 period. And also this time around ARK versus Berkshire Hathaway. Okay. So you had this massive explosion higher, massive drawdown. That's kind of looking pretty close to tracking what was going on back then in the tech bubble burst, right? So could we see a dead cat bounce in tech stocks that takes them up 20, 30%? For sure we could. Does that mean we're going back to a bull market? Not so sure. Yeah. So this is something and the chart on the right shows you that Berkshire Hathaway just been coasting along, doing nothing, and ARK has, since the Corona crash, and ARK has basically come all the way back down, such that all that outperformance has disappeared, right? It's quite funny to see that the kind of more defensive, it's basically vindicating Buffett's more defensive stance. Okay, yeah, he doesn't participate in that crazy upside, but he doesn't have those insane swings. I mean, look at the Sharpe ratio of those two lines, right? I mean, the blue one just crawls up nice and slowly, and ARK's just a lunatic, right? So, and then the last thing on the ARK point is that, it's these retail darlings that have been getting killed, right? So the retail interest in the S&P, and this is a measure from Goldman's, showing that's come down quite a lot, got as high as like 13, 14%, down to about 10%. So these retail guys are scaling back, whether they're dumping, whether they're just buying less calls or whatever, but retail participation in the market is coming off as all these high-flying names are just getting killed, right? All these meme stocks getting killed, all these retail kind of favorite stocks getting hurt. In terms of what's coming up this week, obviously earnings are, in full flow. We've got tech earnings. We've got Microsoft today. We've got Tesla, Intel Wednesday, Apple, Visa, MasterCard, some of the highlights on Thursday, and then Chevron and Caterpillar on Friday. There's loads of other names, but those are the ones that kind of stood out to me. On the macro data front, bits and bobs, but really all anyone cares about is the FOMC, really, right? And what's going to come out of that. So those are your main sort of data points to be aware of and keep an eye on. So commodities, like I said, have been really resilient, right? They've, normally when you get a period of risk off like we've just seen in equities, commodities take a shoeing, right? They're quite high vol, they're quite high beta. So clearly there's some economic underlying strength that commodities are, is helping commodities. But also I think the big thing is the supply side, right? The supply side in commodities is really what's giving it a bit of a bid, okay? So, but it also indicates there's not an immediate deterioration in economic fundamentals, basically. Yeah. Now, this chart shows you the 1 year roll curve across a bunch of commodities. So on the right-hand side, you've got all the individual commodity contracts, and it's showing you that most of them are in backwardation, right? A year ago, most of them were the other way around in contango. Now they're all in backwardation, or most of them are in backwardation, except a few. And so if you take the average of all of those to see what the average 1 year kind of roll yield is, it's about 5%, okay? And that's as high as it's been since 2004. So that's just showing you that just in comparison to the past couple of decades, how tight the commodity markets are in general, right? When it's in backwardation like that, that's a signal of a tight commodity market, right? Where there's not enough supply to meet demand. And this kind of gives you a nice gauge of like how extreme that actually is relative to, recent times or recent decades. Okay, now if we home in on the oil market, just to sort of look at what WTI has been up to, that has been pretty bulletproof if you look at it. I mean, 84, it's still above 84. So, I mean, it's been a very aggressive rally, very few pullbacks. We could call this a little bit of a pullback, but, it found support at, an early retracement level at 82.5. I've got bigger levels, bigger sort of clusters at around 79.5, 74.5 in any meaningful pullback. But to be honest, I just don't see it happening, right? I would think if it was going to pull back, it would have pulled back by now, given how bad the risk off has been. So I wouldn't be surprised to see this thing charge back through the highs and start heading towards 100, right? So that's kind of, the geopolitical noise maybe out of Russia might impact it, but it doesn't seem to have done too much to it for now, right? Now, part of the strength in this has been attributed to what's going on in the time spreads, right? So Eric Townsend, who I follow at Macro Voices, he stays on top of these time spreads. He trades these more than he trades the actual spot. And basically the short end time spreads in oil, which are like the red and the yellow ones, have gone quite backwardated, basically, right? So the idea being that there seems to be a shortage at Cushing of oil for delivery, basically. And that's creating, some concerns, which is what's keeping oil well bid, right? So now that one's rolled off, the front contract, the red one has rolled off, So the next front time spread you need to keep an eye on is the H2J2, and so if that comes back closer to like the rest of the curve, then maybe that kind of worry of a shortage at Cushing goes away and takes some of that support away from the price. But if that starts to blow out again, then you know that that's kind of driving some of that strength in the oil price in the short term, basically. Yeah. So keep an eye on those time spreads, basically. The other thing in commodities that has actually got interesting again is gold. Gold's been boring for months. I barely mention it in the macro calls these days, but it's kind of popped its head up as something worth maybe paying attention to now, right? So these charts on gold that I've put together. So if you zoom out on gold, and that's zooming out pretty far, you can see this monster triangle that's forming, okay? With a resistance level kind of coming in around 1840, 1850 area. So if that breaks to the upside on a more longer term picture, you know, technically there's going to be people calling for a bit of a breakout, which maybe take this thing towards 2000 again. Okay, so that's zooming out view on gold. If we look at ETF holdings, they're ticking up. I wouldn't say it's anything too dramatic, but they are ticking up. It's worth pointing out. That's the red line here that has kind of swung higher since the start of the year. You've got obviously the real yields that's supposed to be a bit of a driver for this thing. When the real yield spikes up, that's bad for gold. You'd expect gold to sell off, right? Gold didn't sell off this time. Now, I'm saying that's probably because gold didn't rally when real yields went to negative 1.2. So now we're kind of at this place where we've had real yields spike back to minus 0.6, and they've stabilized here, as obviously the yields in general, nominal yields have stabilized as well. If we start to see real yields going lower, more negative, and this purple line to start bouncing, that in theory should be supportive to gold. Whether it takes gold higher or not remains to be seen. It didn't manage to do it earlier, okay? But that's the thing to keep an eye on and see if that dynamic does take hold again. So if we break out the triangle, real yield starts to go back and gold starts to break out, then that is a trade that might make sense, okay? The way to maybe play that is through call options. The purple line here on this top left chart shows you the volatility. That's pretty subdued, right? So that's gold volatility hanging around in the mid-teens. Hasn't really done anything for ages because gold hasn't done anything for ages. But the point is, if you do start to get a breakout and you think this thing does start to go, with the likes of Bitcoin continuing to crash, that's going to favor switches back towards gold like we've started to see. If all those stars start to align, then flying into some upside calls or call spreads in gold, given the vol's not expensive, is probably the way to go. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.